Good morning, traders. Welcome to the biggest data point since the last biggest data point. Morning, Stel. Morning, Kay.
Morning.
Guten Morgen.
Everyone ready?
Oh,
Yes, sir.
German as well. Guten Morgen.
Around the world this year.
Kontogulas.
Japanese tomorrow.
Oh,
Yeah, good luck with that. I'd like to see your Japanese, mate.
perfect.
How are you, Ryan? Everything all right?
Yeah, all good, mate. All good. Let's start off. In case you weren't aware, Stel, I don't know if you've got it to hand. Pop your link into your excellent blog post you did this morning.
I will post it right now. I'll post it right now. Yeah.
For everyone to have a good read of.
And I can show some charts later when you're done mentioning some of the things I talk about on the post as well. So.
Yeah, no problem at all, mate. No problem. So yeah, got lots to get through today, obviously with the CPI data coming up. So let's crack into that straight away, get the headlines out of the way. China, according to the WSJ, is likely to name a US specialist as its next ambassador to Washington, seen as a sign of trying to ease tensions further there between the US and themselves. Falling into the rhetoric that we've been speaking about previously of tensions coming down with China and other countries, Australia and the coal, etc., etc. On the data front, China CPI was out overnight. Year on year for December rose to 1.8%, was expected at 1.8%. That's 2 pips higher than the 1.6% prior. Year-on-year PPI fell 0.7%, worse than the minus 0.1 expected, not as bad as the prior minus 1.3%. Still a bit of a mess with their inflation data, with all the COVID wave and so on, so that may take a couple more months to sort itself out. But I'm expecting inflation to become a big part of thinking for China moving forward. With the getting over the COVID wave, reopening, etc. A lot of eyes are going to be on inflation and whether that causes the PBOC to turn more hawkish, which will be a potentially big move for the yuan, obviously. Right, lots of goings on in Japan. We'll start with the Bank of Japan. Probably the biggest, or one of the biggest headlines out was that from the Yomiuri paper or newspaper, saying that the Bank of Japan is to review the side effects of its massive monetary easing at its monetary policy meetings next week. Now, this is quite important because it's obviously talking about the Bank of Japan looking at what their easing is doing. And on the other front, it's been noted by Weston Nakamura, who we follow, who you may have seen on the Traders Summit, who's suggesting that it's a bit of a litmus test by the bank putting this news out now to see how the markets react. Whether they actually do this review or not, it remains to be seen, but he suggests that they might be putting this out in the public view, as I say, to see how markets react to that. Because, as he says, they don't need to go ahead with it. They can pull back on announcing such a review, depending on how the market's reacted. At the moment, the market has reacted by buying yen. We've seen dollar yen down on its lows, so the market is looking at it, but not a huge move. But it is just yet another piece of information that is coming out that potentially means that there's changes afoot at the Bank of Japan. So we need to keep obviously a close eye on that and follow how that turns out. Bank of Japan's survey was out, their assessment of the regions, and they've upgraded the assessment for 4 out of 9 regions and say that many Japanese regions saw their economies pick up or pick up moderately. And according to the assessments, many of them reported that their respective economies, despite being affected by factors such as high commodity prices, had been picking up or picking up moderately, as the effects of supply side constraints had waned and as the resumption of economic activity had progressed while public health had been protected from the virus. So we've seen in the data of late it's been a bit mixed. but the general trend really is that there has been some improvement in the economy. It's not going boom times or anything like that. We have seen a bit of divergence between services and manufacturing, but generally things are heading in the right direction in Japan, and obviously we've seen inflation continuing to rise there. Now on to the wages subject, and as you know, we've been talking about that extensively for the last few weeks, even some months ago, and there's been more news out. Uniqlo, big clothing firm, their parent company Fast Retailing Co. said that they would raise wages by as much as 40% from March. According to this story, new graduate employees would see annual increases of around 18%, and new store managers would see an increase of around 36%. So that's for new people coming in. It hasn't actually said what they'll do for current employees, but they did say that the overall personal costs in Japan would rise about 15% this year. There was another firm, Suntory Holdings, who are a big drinks maker, said that it's looking at raising wages more than 6%. Honda was out also saying they want to tackle wage increases aggressively. Now, I've been looking into more of these stories, and there was also a meeting, a New Year's meeting from some wide range of large firms, airlines, retailers, that sort of thing, who are all looking as well to increase wages significantly. This news has been welcomed by Matsuno, government Matsuno, who said, "We welcome reports of companies that have announced aggressive wage hike policies." So all the ducks are lining up that we are going to get some decent wage news coming from Japan as we get towards the end of this quarter and into the new fiscal year. As I say, we've been banging on about this for the last few weeks. It's starting to happen. What we need to see is how that plays on the Bank of Japan. Now, one of the reasons why we want to do this show, and we do it in the format we do, with basing a lot on the fundamentals, is for situations like this, because this is where it presents these trading opportunities. We've been speaking about the Bank of Japan potentially turning. Kay's been banging on about it for a good chunk of last year, that there may be a surprise. Obviously, timing is always a thing to try and get right, but as we know, at the end of the year, we got a surprise move in the yield curve control, albeit they said it wasn't a monetary policy move. But we are now seeing different factors coming in as to why the Bank of Japan may change course on policy. And if we can get all these ducks lined up and we can get in early, we can see the trades and we can get the opportunities. Because when you get a big change like this, it's going to mean a big move. Now, as you can see from the dollar yen chart on the screen there, we've already had a big move. So there is some risk that maybe some of this has been pricing in, or we don't know how much of the Japan side has been priced into this move versus the dollar side coming from the Fed, maybe calming down on their hawkishness and their hike path. But there is still a big move that can potentially happen here, because we have zero confirmation from the Bank of Japan that they're changing anything at all. And that's going to keep the market guessing for a while longer. But if they do turn and expectations really start to ramp up, there could be some big significant moves still to come in yen pairs. So that's why we like to focus on these fundamentals, because this is what gives you the big moves. And can give you the big pips. Kay, going to bring you in on the Japanese stuff. Snowball's rolling, isn't it, mate?
Yeah. This is, well, I mean, if we are going to invent a new name, it's Yomilix. If Yomilix are right, yeah, then the change is happening. And also, it's been quite if you look at it from a Japanese side, because usually everything is going so extremely slow over there, it's been quite some night. Okay, we've got this piece. If the Japanese insiders are right and saying that it's a test by the Japanese big money, those who handle the money, that is already a big enough change. But then you add to that those wages. I saw this Uniqlo thing come out yesterday. I don't remember. I don't recall exactly when or where. But at that time, it didn't really got picked up by the market. I think people are trying to put stuff together, but it's been quite an eventful night for us in Japan, because if the Yomiuri is right, if they are right about the wages, and on top of it, we've got those the economy watchers upgrading their assessments, and we've got the current account in November, which massively turned positive again. That's a lot of tailwinds for the yen in one evening. So yeah, we have to really take it into account. And I was so the people know in the room, of course, because I'm updating my trades live, and I was showing this euro yen into the 143 zone, which luckily I respected and took my profits up there on my loans. And then this night happens. It really makes me think, and I think I'm going to steer away from it. And I wouldn't be surprised if this combination of what we have read and seen and the comments of the manufacturers and car makers about wages, if they really put their money where their mouth is, a lot could start to happen in Japan. And that indeed, regardless of the move we've already had, could spark another move in yen pairs. So that's going to be likely. It now puts the dollar yen or the yen forefront for the CPI this afternoon as well. I can imagine that if we get a weaker CPI, dollar yen is going to take another hit, a serious one. And if CPI comes in, let's call it in between the weaker and the stalemate, any blip higher in dollar yen will probably find sellers this afternoon. It's a serious tailwind. If everything materializes there, it's a serious tailwind for the yen. We have to bear in mind, of course, that it is still Japan, and the Bank of Japan is not going to raise rates in the same way than the Fed or the ECB right now as well. It's all going to go a lot slower, but the change in Japan is what matters. And that's where the money will go. So if you start to let's assume that they perhaps not completely abandon YCC, but just start to bring rates back into positive territory, and put the band higher, up to 1% perhaps, because we're already trading against their 50 BPs top end of the yield. If they start to change it, it's taking away some of the higher costs for hedging, so people in Japan can more easily stay at home instead of having to go outside. So it's stuff can be on the move there right now. We have to be really careful. And I'm until yesterday I was saying, dollar yen, if nothing changes, is probably the one where I'm going to catch a knife. Well, I'm changing opinion a bit there.
Yeah. Well, just a quick question on the band, the yield curve band. Could they, they keep it plus minus equal, plus minus 0, so 50 pips up, 50 pips down. Could they do something like go 50 pips up, 25 pips down? Have a band like that?
A minus a quarter to 1%, for instance?
Or minus a quarter to plus 50, whichever way they want to look at it.
Your lower end is not going to change much now, because the main interest rate is still at 0 and minus 0.1. So that's not going to change anything. It's the top end which is important.
Yeah, but that's what I mean. They've got plus 50, minus 50 at the moment. Could they go something like not adjust the downside as much as they adjust the upside?
I don't know. I've never seen them do it, so never say never. But I that's not going to be a main case. Let's put it my main case anyway. Yeah. My base case anyway. I don't think so.
Yeah, no, I understood, mate.
And I don't see it completely abandon it, because that would really.
Oh yeah, that would
get amongst the pigeons, and I don't know what's going to happen to the yields then, and yen is probably, I mean, so to speak, going to strengthen 10% in one go.
Yeah, exactly. I mean, you know, we know the size of the moves that we can see based on what they did at the December meeting when they widened the band. So, you know, this is why even small changes like that to their end are not monetary policy can bring big moves in yen pairs. Now, I have entered into a very small short because I've been wanting to be short, as you guys may or may know. I was short going into this high up here. I thought I got a get out of jail card when they intervened up near these highs. I've been short in bits and pieces on the way down. Haven't managed to stay in a position or build a significant position through my own actions of cutting early or the market hitting my traders and things like that. But I really want to be short because I've had this bearish view, as you know, since before the turn of the year. So I'm in again, and I'm going to sit on it, and I'm going to build it. Even if this thing goes to 138, I'm going to sit on it. If we get above 138, 139s, that will be an assessment point. But I feel this is coming. This turn from the Bank of Japan is coming. I think it's going to be big. It may take a while to get through. Got to be careful of the carry being short that one. So I'm going to keep an eye on that. But I want to be in a position in this one like I have been in Aussie dollar for the same reason of being short dollars. But this side, obviously, this trade's got the Bank of Japan in it at the moment. So that's my positioning, and that's why I'm so interested in the news and data that's coming out from Japan. I'm hoping the CPI maybe gives me a better level to sell into, but I find, and we'll talk about the CPI in a bit more, but I find very little reasons why we see dollar yen, dollars particularly, rising significantly and holding on to those gains if it does do that. But we'll talk about that in a moment. A couple more headlines to get out of the way. ECB's Ren says rates will still have to rise significantly and must reach restrictive levels. The cost says the ECB will continue raising rates significantly at future meetings at a sustained pace. That line pretty much echoing what they put out in an economic bulletin this morning. But the term significantly is coming out in all the ECB language. So they're pushing that narrative, as we know. Not that I put too much faith in bank forecasts because they change like the wind. But HSBC sees 50 pip ECB rate hike in Feb and March. And they see the Fed delivering a final 50 pip hike in Feb. And they don't expect rate cuts until 2024. Now, yesterday, Fed's Collins was out backing a slowdown in rate hikes, favouring a 25 pip move over a 50 pip move. That sum has still got to play out whether we're going to get 25s or 50s at the next meeting. The last look, the market probabilities were favouring 25. They still are 75 pips. 75% favouring probability of a 25 pip hike. The balance 25% for a 50 pip hike. So there's going to be a bit of a trade on that, depending on what the market is expecting. Looks like some of the market expecting 25. So if they go a 50, that'll be the surprise trade, and potentially that might be good for my dollar yen getting into better levels, but we shall see. A long way to go. Right, that's it from the headline front. Onto the CPI. So what are we expecting first and foremost? Let's look at those numbers, and then the guys can give me their thoughts on it. So CPI expecting in at 6.5% year on year versus 7.1% prior. The core number 5.7 versus 6% prior. Now, for trading this, we've got to know two things. Okay, obviously, if the number comes in higher than last month, that's going to be a complete shock compared to what the market is expecting. If it comes in between what's expected in last month. Again, that's probably going to be that's going to wrong foot some of the market, because it will show that inflation is perhaps not coming down as fast as people think. Anywhere around the number is likely to be pretty neutral. Obviously, anything worse, and probably anything worse by 2 pips or more, is going to feed into the narrative that we're already trading. Now, both Kay and Stel explained this, their thoughts yesterday. So just to bring them in again, Stel, you had some charts to show. Is that related to the CPI stuff, or just general?
Yes. So it's all related. Yeah. So I don't know, how do you want to do it? Do you want me to take over now and talk about CPI?
Do you want to take it now, mate? And
yeah, sure. Plus charts, and then I give it back to you. So,
no problem.
I mean, for people who have been here every day, I'm going to repeat a few of the stuff that I've said, but just trying to look at things from the bigger picture, let's say. And we have to admit that the market is hoping for a pivot quickly from the Fed, and that's what the market's pricing. If you look at Fed fund futures, which, by the way, you do 100 minus the price, you get roughly what Fed funds rate is expected. This is not compounded, so there's a little difference from the actual rate, but you get an idea. So we can see that we're pricing, so the numbers are dropping, which means rates are going higher. So we're going higher until May, June, mid this year. So a couple of more hikes, and then they start rising, which means that rates start dropping. And by January, we're pricing pretty much a 50 cut. Now the market, so the market is really hoping for inflation to start to go lower quite a bit, because that will mean the Fed will stop hiking and will reverse. The question that we have to face today is, we have this number today. How do we trade it? What do we think can happen? And I think, as Ryan very correctly said, I think the reaction is going to be more violent if we get stronger than expected number. Even if we do get, what's the expectation again? 6.5%. 6.5%. Even if we get 6.6, 6.7, I still think the market is not going to like it, because it will show that inflation is dropping at a slower pace than is hoped for. Because if it does drop at a slower pace, then that gives the Fed less reason to stop and to reverse their rate hike. So this is not the market. I don't think is going to like it at all. So what do I think is going to happen if we get a number which is higher than expectation? So even if it's a little higher than expectation, I think that yields, which, let's face it, are driving pretty much everything at the moment, are going to react a lot more than if we get a weaker number. If we get a weaker number, so then 6.5%, if we get like 6.4, 6.3, there is a chance that yields are going to drop a little bit further, but there is quite a bit of support around here in the 10-year US. There's a 200 DMA, which is coming toward here. There's a 50% fib of this move from the lows in August to the highs in October. And also we have this, used to be a channel, it's been retested. I mean, this kind of all points towards this level here. So what I'm trying to say is the downside in yields is relatively small, and I mean that there is some pretty good support confluence compared to the upside. So if we get a negative surprise in inflation, which means that inflation is higher than expected, then I think yields are going to definitely come up towards 390, which are the previous highs, also at 23.6 fib. And I think if the inflation print is, I'm not talking in a day, right? This is not in one day, obviously. I'm just talking about how the markets might develop from here. And then why not? If inflation is really not looking like it's slowing down much, then I think we could test the highs, 433 or whatever that was. And this is because I think the market's really gone one-sided now. Think about what the market's pricing, and think about what we need to see for the Fed to actually act as the market is pricing. So if you ask me, what do you think the most probable event today is? I think we're probably going to come in line, or maybe a tenth or two below. I still think the most likely scenario is that inflation keeps disappointing to the low side. But I think the reaction is going to be, it's very asymmetric in terms of if we miss one way or the other way. That's what I'm trying to say. And it's a similar story with the S&P. We have this, I don't know how to call this megaphone formation. Anyway, the important line is this descending trend line resistance. And this is quite close. So this is at 4,000. If we if we come in line or miss by 0.1 or 0.2, obviously if we miss by a lot, then what I'm saying now, it could be, we could throw all this out of the window. If we get a full 1 percentage point below last print, that's going to be a big difference. But I'm saying if we come in line or miss by 0.1 or maybe 0.2, you're going to see risk assets getting bought, at least in the short term. And the problem is that we have some pretty nice resistance here at 4,000, which is close. I'm not saying that the markets are going to necessarily get there and stop. Obviously, anything can happen, but there is a resistance coming up. There's a descending trend line, the 38.2 fib, and so we have to be aware of that. But on the other hand, if inflation comes in stronger, then the downside again, I think it's skewed. So first level 3,800-ish. These lows here, and then we could even test the 3,570 to 3,600 area. So just to be aware of where I think the pain and the pressure comes in the market in terms of surprise one way or the other. So yeah, so that's that's what I see, and this is one of the main reasons why I am not yet fully positioned. Far from it. I have you know me, I have my silver longs. I still have my small, it's unfortunately very small euro pound long, and I'm not eager to get into anything yet because this number is a big binary event today. If we get a number of I don't know, 6.5, yeah, in line maybe, or maybe 6.4 year on year, I think that's going to be pretty much a non-event. But anything above 6.5%, I think the market is going to start having doubts and it's not really going to like it. I know it's only a small difference from the expectation, but I think it's the point of inflation not dropping as quickly as the market expects, because the market is now expecting a lot. That's the problem. Then we also have all the other data, which apart from employment, is really not looking good. So we have to factor into our macro views what's going to happen with a potential recession. And there's so many banks now and analysts saying, look, a recession is coming, it's a given. I tend to agree, but obviously it's not a certainty, but data is really not looking good at the moment. So what happens if we get a severe recession? Well, then we go to the we go past this bad data is good for stocks scenario, because really bad data is not good for stocks. That's historically been the case. So it's a balancing act, and for today's number, I still think, and I will repeat, the potential move is skewed towards a negative move in stocks and bonds, on a positive surprise in inflation, so higher inflation than expected, rather than the other way around. Yeah, so that's what I wanted to mention. I mean, I don't have anything else specific to show in terms of charts, but just to be aware of the number coming up and what I think the possibilities are.
Thanks, mate. Thank you very much, sir. Good stuff as always.
No problem.
So Michael's just asked a question. What's your assets of choice for trading either lower or higher CPI numbers? Gold and metals, dollar yen, US dollars, others, and why? Still, you've had a good look there. Is there anything apart from your usual stuff? Is there anything else particularly that you're going to look at? Maybe just take a quick data move sort of thing.
You know what I'm looking at. Silver on the upside if it's weak, and dollar MEX, dollar Norway. Actually, no, sorry, dollar MEX, dollar Norway if it's weak. If I want to play a currency, that's what I'm going to look at. Especially dollar MEX has a really nice carry on the short side. Having said that, if you look at dollar MEX, hold on, where is it? USD MEX, MEXN. We have broken below the previous lows. So if we get a good number, I mean a strong CPI number, this is going to be a false breakdown, and this is going to definitely come up above. So I think I'm going to probably be looking to play the dollar max to both sides, at least in the short term. Also, the euro dollar has been very strong. Again, if we get a weak number, I think this will be a nice play towards 109.5. But I am going to wait and see market reaction and take it from there. So to answer your question, I don't really have much anything new that I'm looking at. Let's put it that way.
Yeah, cool. Understood, mate. Understood. Okay, Kay, same question to you from Michael. What are you looking at, particularly to grab a trade, either to add to a position or just as a sort of scalp short-term play?
Okay, so
if you want to take the screen and just show that chart-wise, then feel free.
Yeah, I'm going to grab it. So, well, there's one obvious one, right? There's one obvious one. After the latest weeks and overnight events, and call it news or articles or whatever, this dollar yen is really looking it's looking like it wants really to come off more. Let's go on the short term first. After the news, okay, let's assume that comes out in line. I think then things are going to remain pretty much equal compared to expectations. So this could continue to slide. I wouldn't say collapse, but continue to slide for as long as we are below this 131.60, give and take. I'll go pips on a CPI data because that's always a big enough number to get weak stops being triggered and whatever. So high 131s should already come in off, and I think if we get a number as expected. If we get a weak number, this one, I don't know where we are going to be able to sell it, but 130.40.60 is likely to be your level of no return for now. If in turn we get a strong number, I probably will not be trading dollar yen, or I can't buy it with what's going on. So I won't probably be trading dollar yen. But let's say if we get a surprise and the market is already short dollar yen from the overnight and perhaps before, see a bit of panic, then we're going to have to look at this 132.80.85 that we saw yesterday. It's really stopped right on there on the 38.2 of the latest move lower. But then if we get a stronger than expected number, I'd rather look to trade a yen cross. And the one that I traded yesterday, and I went out of it, well, pretty much here. That should find now resistance really up there, and I'm not even sure if we get it up there. But if we get any like little move blip higher, perhaps euro yen is one to look at. But the one that I would be looking to trade, if you want to trade yen, is this one. This no, it's not. That's cable. I'll come to that in a minute. Sterling yen. Sterling yen. I think I still got a little bit of a negative bias on sterling so far, expressed via euro sterling. I'm actually flat euro sterling as well. Just going into the numbers, I want to really go into the data extremely light and initiate new positions after the event. If ever we get a blip here, I might be looking to sell this one anywhere towards the 160.5, 161. I think this could be still a good pair to trade the yen in, and that's what I'm going to be looking at. But that's not to do with the CPI. If we take a look at cable, it's been a yo-yo really lately with with the euro sterling as well. It's been following the euro dollar moves, but we are seeing decent offers every time we're going above 122 towards 122 and a quarter. If we get a move a bit lower in the CPI than expected, then perhaps we are going to see a retest of that one. But I'm not sure that cable on itself is going to hold the highs. I'm rather looking at the cable to if we get a surprise overshoot on the CPI, because then I think that this 120.90 figure could be in danger. For a move back down to closer to 120. That is what I'll be looking to trade on a higher CPI than expected. Euro dollar really, yeah, as people know, I'm relatively positive on the euro right now. This on a weak one is likely going to go for the 109. That's what I'm thinking. On the downside. If we get an overshoot, there could be I think 105 is a bit far right now. There could be a move down to already 106.60.80 is going to be a bit of a level. High 105s possible, but I think in the current state of mind of the market, that a move lower in the euro dollar is more likely to going to be counter traded than perhaps in cable, for instance. A move higher in the cable. So I think this, if ever we get down in this zone, I probably will catch a knife as well. If in turn we get a weak data, as I said, I think this one is going to really ramp higher up to 109, I reckon. On the metals, we have to take this gold again, having a look at it, 1900. If it's a weak one, this could be really tested, and why not break above? As I said yesterday, this is one to really monitor on a close today, whether you're above this or whether we are below and trading back onto this what is it, 1860 zone. So it's a bit wide, but it's a big number, so we can see really big moves. So gold is one that's on my radar. 1860, 1900, and of course silver. We've been talking so much about this. Silver is 23, 24 and a half magic levels. I think those are the bands. I'm traveling light. I think it's I still think it's probably going to be good to start rebuilding in this zone 22, 23. But let's see what the data give us first of all in that one. Canada, leaving it alone. Aussie and Kiwi. Yeah, you guys, you are in the Aussie, yeah, Ryan. We still need to overcome this 69.5, right? But if it does, confirm it through 60, 65, then this thing would probably trade over 70 and likely or possibly going to retest those August highs. If in turn we get an overshoot, Aussie could trade back down to 68.5, in my opinion, on the very short term, and then we see what happens. But don't forget the market is trading the China reopening. It is really trading it, and I've been checking in the market. Banks and stuff, and it looks like the market is really trying to trade this. So Aussie, it's whippy, but I can see this find a bid somewhere if we get a setback in the Aussie dollar. But the one on I'm still much more interested in this is this Aussie Kiwi. We've broken the flag, but we're still not breaking above this 108.80-85, and that's to me the magic level where we are going to be. If it breaks, I'm probably going to try to accompany it during this afternoon and further on. I'm going to try to let some of my longs go. Going to try to reload on any setbacks, and see if we get a close below 107.80. I will reassess, but I'm still quite positive on this one. That is one that should not be too much affected by the CPI this afternoon, right? So this is one which could be a bit cleaner to trade. And that is really it. Stella was talking about the dollar mix, but it's come such a long way already, right? Yeah, if we get an overshoot on the CPI, the US yield should tick up a bit, and the dollar should regain some strength. And this one is a fast mover, so I guess we could see some reactions to above 19, perhaps towards the 19.25. That's actually what the level that Stelios was showing as well. So, but in the big line of things, this one is really still oriented very much to the downside. So yeah, I'd be a rally seller on that one if we see one in the afternoon, just because of it's a 10% interest rate currency. And with that, I'm going to give it back to you. Yeah, I'm going to stop sharing and just answer the Sarkis question. Sarkis, yeah, you what happened into the Swiss weakness? I've been trying to figure it out, and apparently, because I thought yesterday there might have been some merger and acquisition flow or so going up because it was going so steady, but apparently it just seems to be just natural flows linked to euro strength and the market not being in any sort of panic mode right now. So you don't need risk of parked money in Switzerland, which still is not giving you much of yields, and as long as you park it down there, it's an expensive parking place still, Switzerland. So that apparently is what's going on, and we've seen the opposite move when the yen was weakening for a very long period of time. Swiss was actually doing very well. And we also had those SNB expectations where SNB said that they don't view the Swiss franc as overvalued and stuff like that. That put a lift on the Swiss franc, and it was the only really risk-off currency we could play. And I think that's now the market is rebalancing what they viewed as you can play the risk-off again in yen, if you see what I mean. And there is some euro strength at the same time, because the ECB is moving faster than the SNB. So I think it's just part of a global rebalancing of funds. There's also been like very good levels in those 98s, 97s. Euro Swiss was holding rock solid. So it's more a market rebalancing than really any special event.
Yeah, thanks, mate. I was going to say pretty much the same thing. I mean, you know, we mentioned it yesterday. It seemed like a good old-fashioned risk on. You know, commodities were up. Your risk currencies like the Swiss and the yen were you know, pairs were going down. The oil was up. So stocks were up. So we looked at. There's a lot going on, as Kay mentioned, and you know, we said at the beginning of the year, I think the crosses are going to be very important this year, maybe more so than the majors, for a bit of the differential description of what the risk trade might be, if that's changing, and also the different divergences between the central banks coming into play as well. So it's maybe a bit of surprise, the timing of it all, but I think this is definitely something that's going to continue with the volatility moving forward. Right, so just to come back to the CPI stuff and what I'm going to be looking at, Aussie dollars, Kay mentioned, obviously one I'm trading, and I'm going to be watching that very carefully. I am still in a little bit of a long that I took down at 68.74, looking to see it shift up high if possible. Now, there's two things I'm looking at from the CPI. The first thing you have to look at is, what does it mean for the Fed? Okay, everything we're trading in terms of the dollar, or pretty much 90% of what we're trading in the dollar, is down to what the Fed is going to do. Okay, expectations of what the Fed is going to do. So the first question you have to ask, whatever the data is, does this change what the Fed are doing? Now, at the moment, they're looking like they're slowing down hikes, but they want to get rates up to their ceiling or close to their ceiling and holding there for a long time. So the first thing you've got to ask, does this data change that? If it's stronger than expected, much stronger than expected, does that mean the Fed are going to raise their ceiling, their high point, if you like? Does it mean we're going to get a 50 pip hike and maybe we start pricing a 70 pip hike? I don't think that's the case. But if you get a move in the dollar that pushes it that way, then I think it's a good fade opportunity. For today, I don't see any real reason why the dollar gains significantly and more so holds any gains that it makes. So for a pair like Aussie dollar, if the number comes in above expectations but lower than last month, as all the guys here have been saying, there will be an upside reaction to yields in the dollar. I think that will get hit hard. I wouldn't be surprised in that scenario we see something like Aussie dollar dipping down and then going on to break the highs thereafter. I've seen that sort of reaction time and time again. Sometimes when you get these big data points that we've been waiting all week for, the market takes its foot off the gas. It wants to do something, but it wants to get over the risk event. And the same with euro dollar. I think there's a good chance if the data's in between expectation and prior, we see a little bit of a sell-off. And then boom, it goes and takes out the highs, and maybe we have a look at 108s and even have a crack at that. So that's what I'm going to be expecting. Now, if you're trading this, you've got to know your levels. Know the levels, where you might run into trouble, where if you get a big move either way, that may peter out. Now, as I say, I don't think the dollar gains significantly and holds any gains it makes. So if you get anything juicy, say, as Kay said, euro dollar down into the 105s, I mean, even down to maybe 106s on a big move, I think that's going to be bought up heavily. And that's the sort of stretch point you want to be looking at to say, right, okay, that's gone far enough. It hasn't changed what the Fed's doing. I'm going to counter this trade. And it may be something you can sit on for a few days and see what it does. So as we said yesterday, get into your charts, pick your levels, look at your stretch points, maybe 100, 150 pips away, where you can say, okay, that's a decent move. This is where it might run into trouble now. That's why I'm prepared to risk a trade on, not something in the middle. The market and money flows and expectations for the Fed, they don't give two monkeys about technical levels. They don't give two monkeys about moving averages. It's only, is this going to change the picture of where the money's going? So what we do is we assign technical levels to those moves and say, okay, you want to be bullish the dollar, fine, but you need to break that level. And if you can't break that level, that's the level I'm going to trade. So my main trades are going to be just managing Aussie dollar and seeing what that does. And if I get a big, decent bounce in dollar yen, I'm going to be looking to sell into that. Aussie dollar may look to take a break if we get through that 69.50. I don't know if I can grab something on the fly. Maybe I'll do that. If we get a decent dip in that, I'll potentially look to add to that one as well. So that's my views for the CPI and how to trade it. One thing I will say is trade safe. If in doubt, let the data flow, see what the market does, look to trade something afterwards. I don't want to see people just saying, I think, and jumping in a trade. You might as well go down the casino if you want a 50-50 bet, or stick 10 quid on a horse or something. If you're going to trade sensibly, manage your trade, know your risk. Right, unless you guys, girls, have got any further questions for today, I think we've covered a ton of it. I hope we've given you a good foundation for getting through the CPI report today. And once we're over that, we'll get back to looking at what the next big data point and the central banks and everything else going on from that point. So after one important day comes the next important day. Stel, Kay, thank you very much for your input as always.
Stel's already surfing, I think.
He's already gone. So he's already putting his trades on the vulture. He's probably front running everyone, getting in there early. So yeah, trade safe, please, folks, and we'll pick up the pieces and see what's happened in tomorrow's show. And thank you very much.
Mañana.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.